What I'm saying is that the markets don't believe they're going to achieve what they want to achieve. The dot plot and the projections they presented was just an amazing case of immaculate disinflation, right? Disinflation without rising unemployment or any kind of recession, any kind of slowdown. And that's what the markets are really not buying. That rate increase that you just pointed to, that's all nominal rate increases, all because the expected inflation rate has just burst out. For the 5-year break-even inflation rates are now 3.5%, way above where it was just a month ago. And that is a sign that despite the hawkish talk from Powell's press conference, they still don't believe that the Fed will be doing this. And I think one of the things that Jim Bullard has said was, we got to get to 3%. We got to get there faster the better. The faster the better. You know, I was writing about this today, and someone wrote back and said to me, why don't they just raise rates to 3% right now? Well, the markets would be very shocked because they didn't think the Fed would be able to do that. And also the Fed is counting, and amazingly, they're still counting on half the inflation disappearing because the supply conditions are going to get better toward the end of the year and into next year. And that we have some doubts about. I think markets have some doubt about, because the war looks like it's extending the supply problems around the world, not just in the commodities, but also to the global supply chains and manufacturing. But, Bill, let's talk about what you mean when you say the markets aren't buying it. There's kind of two schools of thought here, or probably more than that. But one is the Fed is going to do all of this, and as a result, growth is going to slow, and that's why the 10-year yield is still lower than where the Fed appears to be taking the funds rate. The other is they won't be able to follow through on what they want to because the economy won't be strong enough. So what do you think exactly is the message from the markets here? I think given the Fed's new framework, which emphasizes the importance of full employment, inclusive, and maximum employment. Having said that, the markets are asking, can the Fed pivot around to saying we need inclusive disinflation because the poor are hurt even more by inflation? And right now, because the 5-year break-evens are way above 3.5%, and even the 5-year, the second half of that 10-year window, those rates have gone up to 2.25% from where it was a rock-solid 2% before. So whatever credibility the Fed had, it seems to have gone. And I think the fact that the projections are not showing any rise in unemployment kind of implies that the Fed has no intention of allowing unemployment to go up. But it seems to me, how do you read it, that Chair Powell is pretty dang serious about being hawkish right now? I mean, he's telling us every which way, every time we turn around, that he's going to try to get ahead of this. He even said yesterday the Fed would tighten beyond the neutral rate if necessary. Those caveats really make me wonder whether he's serious or not. Talk is cheap, but when we start to see people not finding jobs despite the huge number of vacancies, when people are saying, my God, the businesses are closing. And don't forget, consumption is already showing signs of slowing down. And the red hot sectors of the economy are really real estate and consumer durables. So the smart thing for the Fed to do is to really target the balance sheet, take away that excess liquidity that's feeding that overheated portions of the economy, and in some sense save some of its rate increases for later. Now, I think to be credible, they now are in a position where they have to front load. They have to have a couple of 50 basis point increases just to show that they're serious. But after that, if we can use the balance sheet judiciously, I think we can save ourselves the problem of getting ourselves into the kind of recession that many people fear. Yeah, you've talked about this many a time, how you'd like to see them drain the balance sheet more than do rate hikes. So just a final point here to make sure that people are on the same page. It's you just think as they go about this tightening, the economy is going to slow. I mean, do you think we're definitely going into a recession? It's not a problem if the economy slows, given that we're supposed to grow, if you look at Morgan Stanley's number, 4.3% year on year. That's almost double what potential growth is right now. We have plenty of room to slow without this meaning that we have huge job losses and a recession or anything like that. Absolutely, Kelly. And most of that growth is coming from inventories. If you look at the latest GDP numbers, you strip away inventories, we have less than 2% growth with consumption investment. But the key thing is the Fed can get us into a slow landing by using all the tools and not just focusing on interest rates. And that's been the mantra from the Fed. Primary tool for policy is the interest rate, and we'll use the balance sheet and consider it like growing grass, something in the passive state. I think it's time to reverse course and say we need to slow down the hot sectors of the economy and allow the sectors that are slowing already to just not be affected by higher rates. All right, Bill, great to have you on today. Thanks for your time.
Shepard Smith here. Thanks for watching CNBC on YouTube.